Hello again, everybody. I hope you guys are having a great day. Today, we're going to go over some investment lessons that we learned from 2021, as well as things that can be applied for this year, 2022. And so, kaboom, Mike, we've got not only is it our Bradley Braves mascot, but we got some boom information to share.
Okay, we do. Actually, I'm sharing this to you. My back office, Buckingham Strategic Partners, Larry Swedroe, strategic business partner plus a friend. He's been doing this for 20 plus years, and he puts out this report every year. It's lessons from the previous year, in hopes that we learn from our mistakes on some of these lessons and myths that we follow for the following year.
Yep.
And so, without any other ado, we'll start up with lesson number one. Valuations cannot be used to time the markets. And, even personally, if you'd asked me at the beginning of last year, we would have had the year like we had, I would have said, no way. The valuations were too high and compared to historical. And at best, it'd be a mediocre year. And if you looked at the valuations, they use this CAPE 10, and it kind of smooths it over 10 years, and they were high. And whether you looked at the
Buffett index,
PE ratios, whatever it might be, it was a really good year. So lesson number one from Larry Swedroe. Lesson number two, and this is probably the most important one.
This is his favorite one, yes.
Well, I'm going to cover this all the time. I try to beat this home. So, it's a loser's game, but there were massive dispersions in returns last year, and there was tons of opportunity to beat the market. Because a simple Vanguard 500 index fund earned 28.8%. It beat 76% of all the active funds. So by active fund, I define that for people that don't know. That's a fund where you have a manager or a team of managers, and they have a process that's designed to just pick the winners, and they're going to beat the market. Well, 76% of them didn't beat the market. And his point was there was this huge dispersion. If you look at the returns, the top 10, you had this Devon Energy made 196%. And even the bottom of the top 10, Nucor, made 118. So here's all these 10 companies, 100+% return. Very simple, right? If you're just going to pick the winners, you should have beat the market. And then you look at the dispersion. Here's all the losers. Minus 40% down to minus 22%. But the moral of that story is very few win.
Very few win. I might just add one more thing. It's
okay.
You might have picked Nucor Energy or something like this. But you might have picked them on the wrong day, because really these active managers, not only do they have to pick the right company, they have to pick the time to get in. So there's a lot of challenges to active management. Right. I'm sorry.
And I think we showed in one of our videos earlier where we showed where over time, long time, it's just a small subset of companies that make up the returns. And if you're being active and you miss owning some of those companies, you're going to have a hard time beating the market, which is why most fail. Lesson number three, don't make a mistake of recency. Last year's winners are just as likely to be this year's dogs. That's that we talk about that already a lot. I mean, people get on the train. We had talked about Kathy Woods and ARK, and
yes, they're down.
I guess you could talk about Bitcoin, Facebook. I mean, all the FANG stocks, right? They all did well. Yeah.
Can't last forever.
So, here's a good example here. They just looking at it from an asset class standpoint as well. This is looking at 2020 and comparing it to 2021. The leader in 2021 was REITs, 45.9%.
Oh my gosh.
And then look at the previous year. Who was the laggard of the 11? REITs. They still made 11%. But the point being is that there's a lot of variance, and if you're going to chase them, it's an act in futility for sure. I think this is here we are back to inflation, Josh. I said we weren't going to talk about inflation anymore in the last video on number three, but we're going to talk quickly about inflation. So gold, people say own gold, right, for inflation.
Peter Schiff,
right? Yeah,
Peter Schiff.
Well, let's look at the numbers. Gold ended 2020 at $1,894. Inflation rose at 7% for 2021. Gold fell 3.6% to 1825.
Yep.
So much for inflation protection.
Wasn't a great year for gold.
Lesson number 5: the investment world is in flat, and diversification of risky assets is important as ever. Let's look at the numbers.
Yep.
I mean, you look at these numbers. I mean, it's all over the board, right? With asset classes. I mean, you're looking at the S&P 500 there. The next one, that EFI, is the capital index for all the world, Asia, Europe. Emerging markets, You subtract the differences between those two and the variance you can get there. It's all over. You need to be in a global portfolio,
Especially
just in the
today.
US.
You want to speak to that just a little bit today with our, the U.S. being somewhat historically overvalued, CAPE, Buffett Index. Maybe it's good to have a little bit of that.
We're going to go down
global-
that valuation world. Yeah, but we're not going to change, right? So
Not
I mean,
gonna
the
change,
point
but
being
yeah.
is, and plus you have home bias too, though. People prefer to just own America and not own Europe. And especially the last 10 years, you've had the U.S. has outperformed a global portfolio by a bunch. But if you look at the decade prior to, just the opposite occurred. The global portfolio outperformed the U.S. So the point being, we like to have anywhere between 30 and 40% of your equity portfolio in international
Makes sense.
and stick with it
Yep,
and
stick with
rebalance
it.
to that. Yeah.
So far, I like them. I'm
Good.
in agreement.
All right. Lesson number 6: hedge funds are not investment vehicles; they are compensation schemes. And I think the easiest way to explain it is most people, first of all, they're touted and sold to really high net worth rich people, and they try to make it out like it's
Qualified
the
investors.
premier investment, right?
I
Yeah.
want to be a qualified investor.
And there's a lot of really smart people putting their resources towards running these hedge funds, by the way. And the compensation is very good, though. It's 2 and 20. So it's 2%
2%,
commission, 20% of the profits. Nice.
I would want to sell some of
2
those
and
too.
20.
Yeah.
Yeah. So here's the returns last year. 2021 should have been an opportunity for, when you go back to the stock returns, all the variance was going on. The market did 28%, almost 29. Here's the index for global hedge fund index, 3.7%.
Man.
You know,
That's really terrible, Mike. That's worse than those steak dinner offers.
yes, it is. We're going to cover that.
Get
one
yourself
day.
an annuity with a
We're
steak
going to
dinner.
cover that. Yeah. So here, even longer term, here's that hedge fund index from 2000 to 2021, 2%.
2.2.
You know, the S&P 500, 9.5%. Simple index fund versus the
I
best
call
of the
that-
best hedge funds.
I call that a kaboom statistic.
But everybody always tells you they got their guy too that picks, and it's like, well, okay, so here's the guy for the best hedge funds and how he did. So I don't know. Lesson number 7: correlation of returns of stocks and bonds is time varying. This is something that the economist is going to like. We get talking about
Good
correlations.
correlation. That's very small.
And guess what they mean by time varying is correlations aren't always perfectly working. Okay, so because think about it on a simple basis, you have the risk-free asset class, which is the Treasury, and you have the market index, the S&P.
Yep.
And
Risk premium.
so the data here shows there was 5-year periods where the S&P and the Treasury both returned negative returns, which is not the way correlations are supposed to work. Then you had 21 years where the S&P produced a positive return and the Treasuries produced negative returns. And you had 18 years where the S&P produced negative returns and the Treasuries produced positive returns. Mm-hmm. So you're going to have variance through time, and it's just something about the key to all these, I think, is discipline, diversification, discipline, because there's so much randomness and variance and noise in all the numbers that if you think you're going to move and be in the right spot or your guy is or whatever, the data shows that that's not the case. You're going to end up probably failing. Don't let your political views influence your investment decisions. I've seen this a lot through the years, and I think we probably saw that a lot back in the last election term, and maybe even possibly right now since the last election. You get, depending on whether your party's in power or out of power, and typically what it is, if your guy's in power, you're all optimistic and you want to invest, and if your guy's not in there and it's the other guy, you're very pessimistic and possibly even out of the market.
Yeah, can I make another comment on that? One of
Yeah,
my good
you
friends, I think one of my good friends, he kind of is in the Biden investment club, and he put a great deal of his money into marijuana stocks, right? And they just have getting creamed lately because there's no movement on legalization federally. So you take a risk on a political risk, but or solar panels.
I
or something
remember
like that
a couple
too.
years back when Trump got elected, I was biking with a guy one day, and we'd stop for a coffee, and he told me how he took all his money out of the market when Trump got elected. And I heard another story of a guy that when Biden got elected, he took all his money out of the market. And it's just like both of them got hit hard. Mm-hmm. And they should
talk to each other about their experiences.
Think about it, right? Yeah, diversify.
Yeah, exactly.
So speaking of diversified, lesson number 9,
Kaboom.
diversification
Number 9,
is always working. Sometimes you like the results and sometimes you don't.
Yeah.
And again, that's the whole variance thing and just sticking with the plan.
Life lesson learned
Yeah.
there. Be diversified.
And, you look at the returns here from last year. I mean, obviously domestically, we had a lot better returns than international, but, they still had decent returns. You had 11% returns internationally, but you had over double that with all the U.S. asset classes. But the thing is one, recency, don't think that you're going to get that going forward. And especially with the last decade, we're well overdue to get some regression to the mean with the
Regression to the
international
mean.
diversification. This is one I thought was with the pre-show. We talked about this, and you were like, I don't even ever even heard of this one. I said, you've heard of the January effect, right? You're like, yeah. Well, this is the sell in May and go away myth effect. I mean, that's out there too. So Larry took a look at the numbers, and this is kind of interesting. I haven't seen this for a while. So, source of the myth. Here's the data: 1926 to 2021, November through April, equity premium, stock premium above the guaranteed rate, 5.9%. From May to October, equity premium 2.6%. Okay, but then you look at the data from 26 through 21. The S&P returns 10.5%. Sell in May and go away returns 8.5%. And if you stayed in from May to October, 10.9.
10.9, yeah.
So sell in May and go away. But that's one of them that's out there too. Like we were talking about throwing the bones and the tarot cards.
Yeah,
and
next
everything.
time,
I
folks,
guess we
we're
could come up with that.
gonna bring the tarot cards and say, like, when should we sell? Right.
Right.
This is the bones.
Yeah, so
here.
Larry always likes to leave people with a little parting, and he's basically telling you, look, even smart people make mistakes. We've all made mistakes in our lives. And the key is the differentiating yourselves. Smart people don't repeat their mistakes and they learn from them. So hopefully if you made one of these mistakes last year, you've learned from it and you'll apply it something differently going forward. Because 2022 is going to be totally different. It'll be interesting to see what we talk about a year from now. They're going to be totally new lessons we learn. And granted, the market truly, with all its randomness and variance, will provide us with opportunities to make mistakes.
Mm-hmm.
But if you have a good advisor on your side and someone that tells you don't do that, you'll make a lot fewer mistakes. Trust me.
Yep. Well, we definitely learned a lot from Larry Swedroe, that's for sure.
Yeah, it's good. A lot of noise out there in the market.
A lot of noise out there. Hopefully
our
someday.
goal here at the EI is to cut through the noise and no BS.
Oh, yes, the new hat,
No
right?
BS.
No
We're
BS
working
hat.
on that one. We got these hats from the producer. I'm thinking no BS
No
too,
SBS
but we'll
has
see where
come
we
up
go with
next.
that one.
Well,
That's
folks,
all I got.
that's all I got. We're going to leave you with one more quote here, like from
another
Larry. He
quote.
said, "Act like a stamp and stick to the plan."
Amen.
Amen. Hey, folks, take care. We'll see you next time. We're out.